Let's talk a little bit about housing and essentially the scam that's potentially being set up for home buyers right now. And it's important to pay attention to, at least in the opinion of a Bloomberg writer who says home buyers today are being told a lie. Now, I'm going to give my opinion on this, but let's go ahead and start with this Bloomberg journalist's opinion first. The Bloomberg journalist starts off by saying that realtors or people in the real estate industry today are telling their clients, you should marry the house and date the rate. That is, don't be afraid to commit to a house today. You could always refinance when rates come down. That is the argument that this Bloomberg writer suggests people in the real estate industry are telling their clients. Now, I hate to say it, but I personally find that eerily similar to what happened in 2006 and 7. That don't worry, as long as you can afford the payment for the next year, you could always just refinance at a lower rate. I personally think that is a very dangerous argument to make. You should not buy a property with the assumption that you could ever refinance it. That is very risky advice, and as a personal financial advisor, hashtag not personalized financial advice for you, I would be very hard-pressed to find that okay for anyone. Now, the Bloomberg article and the journalist go on to say that exactly this might be bad advice, because even though you think you might be dating the rate, you might find out that you're in a long-term relationship with rates. In the last 10 years, rates averaged at 3.78% for a typical 30-year fixed-rate mortgage. However, this Bloomberg article or journalist goes on to say that generally, people say it makes sense to refinance only after rates have dropped 1 to 1.5%. This is despite the industry saying to people that, hey, you could refinance after rates even just drop 0.5%. Now, the Bloomberg article author didn't write this particular part, but I think it's worth remembering that when people say you can refinance, it's not as simple as just snapping your fingers and saying, boom, I'm going to refinance to capture a lower rate. As a former licensed lender and still a licensed real estate broker who's done hundreds to thousands of transactions probably at this point, it's important to remember that every time you go to refinance, you have to get a new appraisal, you have to pay for escrow again, you have to pay for title again, and that's actually really important because not only do you have to pay the loan costs of whatever loan you're getting, the loan fees, which are generally called discount points for your loan, you could pay points to get a lower rate, or you could take negative points to potentially take a higher rate, which sometimes that makes sense. The shorter time frame that you have a loan for, generally the more negative points you want to take. The longer time frame, generally the more you want to buy down a rate. Typically, it doesn't make sense to buy down a rate unless you're holding a loan for more than 7 years. The reality is most people probably won't hold their loan for 7 years. But remember the costs that you have to go through if you want a new loan. You have to pay for escrow and title again. You have to pay those loan fees again. And most importantly, you have to pay for that appraisal again. And since most first-time homebuyers put down a median down payment of just 7%, and most homebuyers who are not first-time homebuyers, so second, third, fourth homebuyers, put down just 13%, it's really important to remember that if you put 5% down and then you want to go refinance with a new 5% down loan, but home values fell 5%, then technically you have zero equity. Now, you might not necessarily think that home values have come down 5%, but it's actually not up to you when you're refinancing your home. It's up to a third-party chosen appraiser. And if that third-party appraiser is convinced that homes are on a downtrend, they might want to minimize their own liability in appraising properties, being more conservative, therefore, on valuations, meaning even though you bought a place with 5% down, you might not be able to get a refinance appraisal to say you even have any equity in your home. Now, anecdotally, and this anecdotally means from my experience, I find that refinance appraisals almost always come in lower than purchase appraisals. That's because with a purchase, there seems to be this industry push towards getting people into homes, whereas in a refinance, it comes across as a little bit more of like, well, you just want a lower payment, or, oh, well, you just want cash out of your property. And so appraisers tend to be even a little bit more fine-toothed on refinance appraisals. So I actually really agree with this Bloomberg opinion writer who suggests be careful about thinking you could just refinance in the future, because not only are you going to have to pay a lot of fees to refinance in the future, again, escrow, title, appraisal, loan fees, but it also means you're going to be facing tougher appraisals. So those are two reasons right there not to bet on your ability to refinance. So fees, tougher appraisals. But number three, remember, if home values go down, you're screwed. So if you were planning on refinancing, right? You put 5% down and you think you're going to get another 5% down loan. Well, if home values fall even just 1%, you got to come out of pocket to pay more money towards the value of your home to try to refinance. If you put 20% down and home values fell 5%, you'd have to come up with another 5% in cash, which could be 25 grand on a 500 grand property, plus the fees just to be able to refinance. That's wild. That's not ideal. And since mortgage rates so far have been bouncing around pretty high levels, you got to ask yourself, what is the likelihood of mortgage rates falling anytime soon? Well, the expectation is that, hey, mortgage rates will obviously plummet as soon as inflation is conquered. But wait a minute, how close are we to actually feeling like we're definitely seeing inflation get conquered? Well, here's a chart of mortgage rates. This chart of mortgage rates shows you that we're not convinced. Obviously, we had a decline in mortgage rates towards the end of 2022 that actually led to some temporary pickup in real estate pricing. You look and talk to a lot of real estate agents today, they'll tell you, hey, January seemed like it was a lot busier than December or November. Well, yeah, because rates plummeted. They fell to almost under 5%. We could just zoom in over here. They fell almost under 5%. Whereas the level where we're sitting right now is closer to this level. Actually, probably 7% is probably somewhere right around here. That's probably right around that 7% level. Let's draw that straight. It's probably right there if we try to get the midpoint between 8 and 6 over here. So we went over 7%, and now we're knocking on the door of 7% again. So the idea that for sure rates are going to be lower is another mistake. So now you've got a few things if you're betting on refinancing, if you're buying a property right now. Number one, fees. Number two, harder refinances. Number three, rates may not come down. And number four, you might actually see property values continue to trend down. And in my opinion, that's likely until we are convinced that the fear of real estate is behind us. Consider, for example, when we go over to the Redfin data center. Now, we've talked about this before, but it's worth looking at some of the latest data. So if we go to the Redfin data center, we can kind of see what's going on with median prices in various different counties and also nationwide. Now, it's very important to remember that the big argument that real estate is going to maintain, its value right now, the biggest argument right now is that, there's so little inventory. Let me strike that. Oh, I got two of me on screen here. Let me strike that really quick first. It's very difficult in the first week of March to talk about how little inventory there is because there's a phenomenon that happens in real estate that most listings expire at the end of the year. So December 31st is when most listings expire. Most listings go on the market springtime, generally around March to May. So the inventory surge is what we're just now walking into. And the Redfin data center just updated their pricing on a 4-week rolling basis for the nation. And it's actually ticking lower again. Look at this, folks. Let's zoom in over here. So what do we have? We have a 1% increase year over year in pricing at the beginning of the year. And even if this just stayed flat, we've talked about this a million times before, even if we just stayed flat at 345, let's say we stayed flat at 345, when we get to peak fear, which would be somewhere around, what is this level over here? This is going to be June. We're not actually going to get that data probably until like August because it all lags. But anyway, look at this. You compare 388 pricing to 345 divided by 388, you're looking at an 11% nationwide decline in real estate pricing, assuming real estate stays flat. And real estate actually started ticking up again here very briefly because rates fell. But what's happening now? It's actually ticking down. See, now, if real estate actually continues to trend down as we compare to this hump over here, we could potentially be looking at 15 to 20% price declines nationwide. Now, that is nationwide. There are certain areas that are doing quite well. Tampa, Miami. Well, Miami is just killing it. Miami is so far the only place that I've noticed that actually seems to be positive, above the peak of last year. And that is potentially explained away by migration. But nationwide, if we look at areas that were pretty hot, like Austin, Texas, or Phoenix, look at that. We're trending down, much like the nation is trending down. Let's try San Diego, California. Trying to catch up a little bit, so a little bit mixed over here. I encourage you to use this to look at your own particular area. Look at Boise, trending down, substantially lower than where we are from peak. 547 down to 438, right? I mean, look at that, 438 divided by 547. You're at 20% of a decline. So you're seeing different trends in different areas of the country. Atlanta, I believe, is actually doing pretty well. A lot of the South, let's write it correctly. A lot of the South has been doing very well. See, look at that. You've got a little bit of an uptrend trying to start here. We'll see if that maintains because rates are increasing again. And that could actually drive even Miami and Atlanta down. But most markets as a whole, when we just look at nationwide, we zoom out nationwide, we can see the nationwide trend is down for 2023, continuing the downtrend that we saw the second half of 2022. And so that's not exactly the best case scenario if somebody's speculating on real estate solely trending up. In fact, Redfin indicates that right now, U.S. home prices are dropping year over year for the first time since 2012. And that's probably because we are at the lowest level of home affordability that we have seen since the great real estate crash of 2008, since basically the housing bubble. The only thing keeping the market up right now is inventory. And so if we click on the new listings tab right here, so far we're not seeing a surge of new inventory above previous trend. If anything, inventory is staying stable, or below trend, I should say. Now, one of the reasons for that are because people have locked in their lower interest rates, right? So they're less motivated to sell and they're more likely to rent than give up their lower interest rates and sell, especially since they're more likely to stay in place or remodel than go buy something else and spend a fortune on a mortgage rate that could be twice as high. If you've locked in a 2.8 mortgage rate, why would you go to a 7% now? So really what you're waiting for is potentially that spring surge of inventory and maybe institutional liquidations. For example, I was just in, where was I? I was just in Colorado. I was just in Aurora, Colorado, and I saw multiple listings by Invitation Homes showing that Invitation Homes is trying to start liquidating some of their portfolio in certain areas. That's because a lot of real estate investment trusts, like Invitation Homes, are starting to see redemption requests, specifically like KKR, Blackstone. A lot of large companies that own residential real estate are facing liquidation requests. And that potentially means these companies have to dump their real estate. And maybe we'll see an increase in inventory. So the worst case scenario for real estate would be real estate prices stay flat right now, rates stay high, and eventually fear and more inventory drives prices down more. That's the worst case scenario. Certain areas are doing better than others, but that's the way the real estate market works. In fact, people like to say all real estate is local. So you could use things like the Redfin data center to see how real estate is doing in your area. But most importantly, it does seem like for an individual, there probably are going to be opportunities to take advantage of this real estate market. That's why I have a real estate startup called HouseHack, which you can learn more about at househack.com. But if you really want to educate yourself on real estate, I encourage checking out via the links down below the 0 to Millionaire Real Estate Investing course, which really shows you the path of how to best purchase real estate, in my opinion, to make the most wealth in the fastest way possible, getting below market value deals in real estate, single families, multifamily, property management rules that you should follow, how to hire the best agents and property managers, all of that consolidated into one place. Check those out via the links down below. But is it possible that real estate ends up flip-flopping and just recovering from here? Sure. If inventory stays low and we end up in an environment where maybe we are beating inflation and maybe the Federal Reserve can soften their aggressiveness on real estate, on mortgage rates, then absolutely it's possible. The real estate market ends the year positive rather than negative. So we'll have to pay attention both to our local real estate market and the Federal Reserve to know exactly which way things are going.